Ladies and gentlemen, good day and welcome to the Jubilant Foodworks Limited Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Deepak Jajodia. Thank you, and over to you, sir.
Thanks. Good evening, everyone, and welcome to Jubilant Foodworks Q1 FY2024 earnings calls for investor and analyst. We are joined today by senior members of the management team, including our chairman, Mr. Shyam S. Bhartia, our co-chairman, Mr. Hari S. Bhartia, and our CEO, Mr. Sameer Khetarpal, and our CFO, Mr. Ashish Goenka. We will commence with key thoughts from Mr. Hari Bhartia. We will then turn to our CEO to share his perspective. After the prepared remarks from the management, the forum will be open for the question and answer session. A cautionary note, some of the statements made on today's call could be forward-looking in nature, and the actual result could vary from the statement. A detailed statement in this regard is available in Jubilant Foodworks earnings documents. We will share the replay of the call on the company's website under the Investor Relations section. I would now like to invite Mr. Hari Bhartia to share his views with you. Thank you, and over to you, sir.
Thank you, Deepak, and good evening to all of you. Welcome to our earnings call. Today we held our first quarter board meeting in Bengaluru, which is incidentally the city with biggest Domino's network in India. Also the first city within Domino's ecosystem globally to offer 20-minute delivery promise. City where we launched our first Popeyes restaurant and will also soon become the city to house our biggest commissary with regards to capacity, investments, and technology advancement. Turning to our commentary on results, we continue to focus on providing value to our customers and to drive order-led growth. The quarter saw healthy order-led growth. With concentrated efforts, we have been able to stem the decline in ticket on a sequential basis. On the cost side, we are lapping on a higher base. While the prices for the key ingredients remain elevated, the sequential price increase seems to have halted. Cheese price remain high, and the recent spike in vegetable prices does pose some challenges. In such conditions, we are focused on driving efficiency and cost savings across lines and leverage on our strengths. Thanks to our very unique commissary-based sourcing and supply chain strength, we are able to offer superb value to our customers at industry-leading margins. This also helps us in ensuring uninterrupted supplies to our stores despite steep price increase in some of the vegetables. We have also stepped up the intensity of new product introductions across the spectrum of prices. We recently launched the spicy range of new pizzas at an affordable price point of Rs 179. As shared in previous calls, we will continue to invest in our future growth. Though we made a slow start in store network expansion, we remain committed on the full year guidance for both Domino's and Popeyes. Our state-of-the-art multi-brand commissary in Bangalore will commence production in August. At full capacity, it would be able to serve 750 plus stores. We are delighted and equally humbled by the unprecedented response received from our loyalty program, Domino's Cheesy Rewards. Thanks to our deep commitment to constantly identify ways to offer more value to our customers, incredible brand trust, and service satisfaction, we now have more than 16.8 million enrolled members, and their order contribution has reached almost 48% in June of 23. This is an incredible testament to the strength of our operations, our technology ecosystem to come together and champion the initiative to reward loyal members. We remain fully committed to our relentless pursuit to raise the customer service, look inwards to improve our systems and processes, and work to ensure that we emerge stronger from the current challenges. With that, I will now request our CEO Samir to share the performance highlights and progress on our initiatives with you. Thank you.
Thank you, Mr. Bhartiya, and good evening to everyone. Thank you for joining the call today. We reported revenue of ₹13.1 billion, up 4.6% quarter-on-quarter and 5.6% year-on-year. Our strategy of customer and market first, technology forward, and being operationally excellent is beginning to yield results. Average daily sales for mature stores grew by 2.7%. We arrested the decline in ticket size while continuing to grow our volumes. App installs, loyalty enrollments all led to a growth in delivery channel in sales of 8.4%. We also executed efficiently to improve EBITDA margins by 97 basis points sequentially. Despite key input costs holding up, our gross margins at 76% expanded by 75 basis points sequentially. EBITDA margin at 21.1% increased by 97 basis points sequentially, and our PAT margin came in at 5.7%. Popeyes in the last 4 months have expanded to 5 cities in southern India, and we continue to get love of customers indicated by the long queues when we open a new store. I continue to stay bullish on the growth opportunity that QSR as an industry presents in India. Let me now share updates from the lens of our key priorities. First, being customer and market first. In Domino's, we heard our customers and plugged a key portfolio gap with the launch of spicy pizza range and with 4 new pizzas. The entry point for this range was kept at ₹179. Just to remind everyone, Pizza Mania range starts at 49 and extends to 169. So this is ahead of that, and therefore this helps improve ticket price. We refreshed our Pizza Mania range, which I spoke about in the last earning call. This is a big success. It is an important reason for driving volumetric growth and is also a hook to recruit new customers from the unorganized segment. Thanks to our unique commissary-based model, which offers high-quality product, high fill rates, and low prices without diluting the gross margins. We are an omni-channel company. We registered highest ever in-stadium sales growth during IPL matches and serving customers on a moving train. Our network of 1,800 stores allows us to bolt multiple channels and serve new channels of customer demand. We opened 23 Domino's stores in the current quarter and entered 1 new city, taking our Domino's India network to 1,838 stores across 394 cities. We are not revising our network guidance, and continue to maintain store opening of 200 to 225 and remain committed to expand our network as per our guidance. In Popeyes, we added 4 new restaurants and entered 2 new cities, Manipal and Coimbatore. During the quarter, Popeyes is now also available on both the aggregators, i.e. Swiggy and Zomato, in addition to our own assets. This has resulted in higher share of delivery orders. In July, we also entered Hyderabad, our fifth city. We are again humbled by the response received by Popeyes, and we are working towards opening 30 to 35 restaurants this year. In Dunkin', as you are aware, coffee consumption is on the rise. We introduced 2 new international flavors and opened 1 new restaurant. We now have 9 coffee first stores that are building the habit in their trade areas. In Ong's Kitchen, we continue to see robust growth in revenue with both order and ticket-led growth. Customers are loving the offerings from Indian-style Chinese. We added 2 new stores in Delhi during the quarter, making the tally to 15 stores across 3 cities. Turning to international operations, in Sri Lanka, the system sales grew 13.1% and the company opened 2 new stores, taking the network strength to 50 stores. The company introduced again an entry price point product called Domino's Roasties, stuffed roasted bread with delightful local Sri Lankan twist. In Bangladesh, system sales grew by 69.6% and the network expanded to 20 stores. The company introduced Choco Breadsticks. Our second priority relates to data and technology forward. The consumer engagement levels across different metrics continue to remain elevated. The cumulative enrollment of Domino's Cheesy Reward grew by 23.5% quarter-on-quarter to 16.8 million as a cohort base. This cohort of users in low, medium, and high frequency have also improved significantly. The quarterly app downloads scaled to a record high of 10 million, and monthly active users on the app came in at 10.3 million. With the launch of new redesigned user experience in our Domino's India app, consumers get an immersive experience leading to higher conversion. The launch of reorder widget this quarter is meant for users whose primary determinant is to get great pre-order experience, is to quickly order their favorite customized pizzas. She is a user who prioritizes speed of order over the application of some discount coupon. This improves conversion, drives frequency, and improves margin. There is clearly more work to do to fully service the demand potential in our stores. During the quarter, we analyzed app open signals to decipher the demand emanating from unserviceable areas. We optimized the delivery coverage area where we resulted in capturing higher demand from the existing network while upholding the high service levels. Our third priority is to continue to drive operations excellence. Regardless of when the external demand environment will become a tailwind, we are looking inwards and constantly trying to further enhance in all areas of operations. During the quarter, we launched several efficiency enhancements programs to drive process simplification and productivity improvement. I had talked about Project Vijay. We have made this as an organization-wide program, and we are seeing more ideas every day and better execution leading to margin expansion. We dialed up sourcing efficiency, efforts to localize ingredient, and working to develop alternate vendors, resulting in improved cost base without impacting the quality. New stores opened across brands saw material improvement in month 1 sales as we implemented our local ops and marketing playbook. Our fourth priority, essentially a prerequisite for delivering on the first 3 priorities, is the foundation of people and culture. One of the key actionables in this area was to control high attrition among the frontline team members. This has led to positive outcomes now. A series of targeted interventions have helped a STEM sequential attrition trend. During the quarter, we launched a defined career progression track for our frontline teams, and we intend to codify various growth opportunities and elongate their careers in Domino's. We also stepped up our focus on diversity, inclusion, and equity, and continue to strengthen our foundation of, which continues to strengthen our foundation of people and culture. We now have 55 all-women or pink stores, as we call it. With that, now let me turn to the moderator to initiate the Q&A session. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vivek Maheshwari from Jefferies. Please go ahead.
Hi, good evening, Samir and team. A few questions. First is on the dine-in side, the revenues were flat in this quarter. What exactly is, your assessment, or why there is a differential, quite a bit of a differential between delivery and dine-in? What explains that in your view?
Hi Vivek, good to hear your voice. I think there's no specific underlying reasons. Like we want to improve our dine-in experience. We want to grow that. A lot of efforts are being on. We did see a little bit of a slowdown and slower footfalls in our mall stores. But I would again focus on our internal path forward. We do see order-led growth. Like I mentioned, we have arrested the ticket decline. We are improving the store experience as mentioned in our presentation. And there's no specific reason, but we do see order-led growth even in our dine-in.
Mr. Maheshwari, you may please go ahead with your further questions. As there's no response from the line of Mr. Maheshwari, we proceed to the next question from the line of Amit Sachdeva from HSBC. Please go ahead.
Hi, good evening, and thank you so much for taking my question. Samir, my first question in on 20-minute delivery. As you talked about in Bangalore, the 20-minute delivery was implemented quite ubiquitously, if I may say. What has been the experience in Bangalore when it's fully implemented, and could you give us a path how it is being rolled out in other markets? What would be the scope of it now that you have sort of done the full city, and what time frame you're looking at, and what sort of impact it is already having? If you can share some experience of that would be quite useful.
Hi Amit, again good to hear your voice. Great question, Amit. Like I mentioned, this is a big differentiator. Delivering under 20 minutes consistently, we've seen the like-for-like growth to be higher wherever we do it consistently. Bangalore continues to see higher levels of order-led growth versus other cities, and therefore it is also reflecting in our higher growth in the delivery channel. These are one of the reasons why we continue to excel in delivery. And that's the reason why it is going faster than dine-in. In terms of expansion, Amit, like I said, safety first, and then everything comes later. We realize that we have to add more stores, right? And we're finding more and more wide pockets of the city as the city is expanding, and 60% of the orders, like I said, in the rest of the country continue to be less than 20 minutes, and that's why we have higher repeat rates. So internally we have taken a target to expand to more number of cities before in Q3 after this rainy part of the season ends. As we expand more stores, make sure we have the right coverage in the other cities. Bangalore has been a very positive surprise for us.
Okay, great. So possibly as we approach the second half, where Q3 comes in post-rain, you probably would see slightly more pervasive impact of delivery for at least helping you with like-to-like growth. Is this a fair expectation one can build on that sort of delivery initiative?
Yeah, I think we also, during rains, we also see a positive impact because we've strengthened our delivery infrastructure.
Sure.
As the rider availability comes down, we have now better geared to manage rains, and the part of the reason is we were focusing on 20-minute delivery. It makes the overall system a lot healthier.
Got it. No, that's very helpful, Samir. Thank you so much. My second question is on Popeyes. Clearly, when I hear your commentary and that Popeyes is giving you very positive responses where you are opening, and it seems that product market fit is fully achieved. Customer is, at least from the face of it, is liking it. You also have a reasonable agenda for network rollout, 35 stores you want to be opening this year. So my question is that what will be the minimum number of stores there that you will feel comfortable sharing the Popeyes revenue and contribution margin, etc., separately from the overall numbers? And how has been the past quarter for Popeyes stores? If you can, while the Domino's numbers are talked about, but can you share some operating color for Popeyes as well, how it is shaping in this quarter, how it has sort of done?
So Amit, if I may come in, thanks for the question. I think wherever we are opening stores in Popeyes, it is exceeding our internal expectations and action standards. But I think the brand is still at a very, very inception stage, and I think we don't feel comfortable at this stage to be sharing numbers around it. I think the network has to build to a certain meaningful scale before we can start sharing those numbers. So we will internally evaluate and maybe come back as to at what stage we'll be able to share those.
And in terms of operating color, I think our sandwich in a brioche bun, bone-in chicken, and the store opening playbook is getting harder and harder, it's getting better and better, and that is what is causing the lines outside that you see. We are also able to sustain, not only in week one, we are also able to sustain a lot of that momentum. Like I mentioned, we are live on both the aggregators along with our own app, so therefore delivery as a channel has also grown. So overall, feel good about the customer love. We of course need to open stores. That is the primary task for the team, and we are looking forward to opening 30 to 35 Popeyes stores this year.
Great, Samir. Thank you so much. Ashish, if I may suggest, basically, it will be great at whatever stage you are comfortable with. Probably if you could share the key numbers from Popeyes, whatever that scale is, if not at the corporate overhead level, but at least gross margin and contribution margin level. If you can step it out from the overall numbers, that would be very, very helpful. Whenever you feel comfortable.
Yeah, I think we have made a note of it, and we'll certainly come back on this.
Thank you so much. I'll stop here and come back in the queue. Thank you.
Thank you so much.
Thank you. The next question is from the line of Nihal Jham from Newma. Please go ahead.
Yes, sir. Thank you so much. Good evening, Samir and team. Samir, the first question was, you've been doing...
Nihal, I'm losing you. Nihal?
Am I audible? Hello?
Please try again.
Hi, am I audible?
Yes.
Yeah, I'm so sorry for that. I was asking that you've been reporting the monthly active user data. Now, what I noticed is that this quarter we've seen a fall in the MAU number, whereas this is a quarter where you see IPL, and I would assume the activations were highly. And even the data that you shared, there's never been a fall versus this quarter. So just wanted to understand, is it in any way different engagement or anything specific that you want to highlight on this number?
Yeah, I think no alarm, nothing. We've actually just relooked at our sources of traffic, and we did a quality assessment, and we reduced performance marketing in channels where the quality was bad. So our conversions have gone up, our app orders have gone up, So from that perspective, let me assure you, there is not that customers are not loving our app. Our ratings have gone up, our installs have gone up. We're just more focused on channels which give us higher conversion. So it's more about prioritization of performance marketing spend, nothing else.
Sure, Samir, that is helpful. The second question was, you've maintained obviously your target in terms of the number of stores for Domino's at around 200 to 225. Is this quarter a reflection just of the current environment in terms of taking it a little light and maybe and also on the 200 to 225 stores, would we see that concentration now being in more of our existing cities, and incrementally the number of cities that you are historically adding on a year basis will not be similar?
Yeah. So firstly, I do see a healthy pipeline that is there in the system where we have gone ahead and done the negotiation. We've given approvals as an investment committee. So see the overall 200 to 220, I am not very concerned at the moment. This quarter, I think it's a little bit of a slow start, I admit. I think reprioritizing where to open stores. In terms of the mix, we will continue to expand, like we said, across tier 1, 2, 3 cities and split the stores somewhat in the proportion that we have done in the past. So no major deviation for our store expansion strategy. But whenever we open a store, we assess that individual store. It should give us the payback of 2 years or about. It should be in line with our margin expectations. So I think those markers continue to be there, and at the moment, I believe 200, 225 is a good number that we are gunning for.
Understood. My final question, sir, was on the inflation bit. You did mention that there is comfort, especially with prices at least remaining flat. But we do see a spike happening in vegetables at this point in time. So overall, despite the recent news on the spike in certain commodities, is there comfort on inflation, or it still remains monitorable at this point in time, and we see how it goes?
So Nihal, I think overall basket remains still elevated as compared to last year. So while we did see some moderation sequentially, especially on cheese prices do remain significantly elevated versus last year. But I think sequentially we are seeing some moderation. And I think the recent increase in vegetable prices again is an area of concern. But when I look at the overall basket, I think we are seeing some level of stability, at least on a sequential basis.
Got it. I'm done. Thank you so much.
Thank you so much.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi. Thanks for the opportunity. My question is an extension of the previous question. So see, worst of the inflation seems to be behind us, especially in the key raw materials of cheese and milk derivatives. So assuming that the trend continues and picks up in our favor for the rest of the year, how do you plan to repurpose the saving in terms of conflicting objective of margin expansion versus reinvestment that you'll have to do in the business? So how do you plan to play that kind of competing objectives that you have now from here on?
Yeah. So I think firstly, the inflation is not turning negative, which means there is no, compared to last year, the prices will not come down. At least we have not seen it come down in cheese. So it may not increase at that pace, or may see a slight deflation sequentially. But as we look at it compared to last year basis, the price of cheese is continues to be higher than that. Having said that, we are finding internal efficiencies and opportunities to improve our margin, which is reflected. The areas of investment continues to be in Domino's India, where we'll open more stores, where we will strengthen our frontline training and infrastructure to our store managers, and also in digital and technology assets. So those areas of investment I will continue to double down on, and Ashish, you want to add anything on inflation? Yeah,
I think you've covered it, Sunny. So yeah, so nothing more to add.
Yeah, thanks. That's right. No, yeah, that answered. My second and last question is if you can comment on the competitive landscape, mainly from the lens of regional competitors like Lapino and Avan Story and others. And do you track or there is a measure that or internal metric that you have to measure our market share versus some of these regional competitors who are not in public domain? We don't have much data on those competitors.
Yeah. I think we do track. Firstly, I see competition, right? I'll keep on saying this, maybe sound like a broken record. In a $50 billion market, pizza as a category is about $1 billion. So we hold the dominant share in it, and we do track that. We do track our share of expenditure. We do track our top of the mind measure metrics, and we also track shares across channels. So from that perspective, I think I don't think there is a concern. But for us to grow, we have to take share from other categories and convert unorganized to organized, right? So that is the job to be done by the marketeers and our operating teams. So on that front, we are doubling down in terms of our network expansion and also range that the menu, the range that like we spoke about, spicy is one piece which is very prevalent, and again we are the first country within Domino's portfolio to have a spicy range. Again, learning from our feedback from the customers, and then our technological assets which differentiates us from the competition that you spoke about. But the larger point being, pizza is a $1 billion category, and rest there is a $49 billion market outside of it that we need to capture.
Great. Thanks, sir. That's all from my side, and all the best.
Thank you. The next question is from the line of Sheila Rathi from Morgan Stanley. Please go ahead.
Yeah, thank you very much for taking my question. My first question was with respect to the demand trends. Now we are about 25 days into the second quarter. So, Samir, I wanted to hear from you if we are seeing some green shoots with respect to a demand recovery, and if you could even highlight what are the trends we are seeing in Tier 1, Tier 2 cities versus, the smaller towns. So that was my first question.
Yeah. So, I, again, like I mentioned in my opening remarks, Sheila, that our strategy of customer and market first and data and technology forward is playing out, and across tiers and across channels. To give you more color, our mature stores ADS grew 2.7%. We believe the strategy that we have put in place is yielding results, and therefore I'm confident that it will only accelerate as more and more parts get executed. So the spicy range was one such example where we were able to arrest the decline in ticket size, get more consumers to try mid-range pizzas versus lower-range pizzas. We have also instituted combos on our app and on aggregators, and therefore, as the order-led growth continues, if we improve the ticket size, this should result in better growth, actually.
Understood. And in terms of markets, are we seeing any different trends, or broadly the demand trends are similar?
See, I think it is a little bit patchy, to be very honest. Last quarter, I could see malls to be doing very well. This quarter, I saw there was a slowdown. It's hard to pick up a trend for me to say. We opened one store in Tier 4 city, actually did exceedingly well, is doing exceedingly well. I continue to be surprised by what the latent demand that exists in Tier 3, Tier 4 cities. Tier 1 cities, as offices and as people come back and offices open more, there's more back to work. You do see some of those tech institutes and educational institutes after the holidays also picking up. So I don't have a clear trend line. It is kind of a bit moving around, but I'm not teasing out anything at the moment that Tier 1 is growing faster than Tier 3, Tier 4. The Tier 4 stores that we opened actually did exceedingly well.
Understood. And Sameer, if I may ask another question with respect to, India is hosting the Cricket World Cup this year. So are we having any kind of strategies that in mind in terms of, innovations which, could work out in favor for us and we could benefit from this event?
Yes, I think and I mentioned, I think in the last earning call that when Surya Kumar Yadav hit a century during a T20, our sales went up. So cricket is one occasion where friends and family sit together and order a pizza. And we do plan to capitalize. IPL was one such event. So in fact, I shared in my opening comments that we also started offering in-stadium pizzas, and that we could see these sales spike up during the season. So definitely we have plans to capitalize on World Cup, which is in and around Diwali in Q3 time frame.
Right. And then my final question is with respect to the new innovation at 179 rupees. Is this our endeavor to offset the inflationary pressures we are getting and introduce the new products at a higher price point versus say 169 earlier? Now we're taking it up to 179. And is the worst on the inflation side behind us? That's it for me.
So yes. So Sheila, so firstly, I'm finding these opportunities from what customers are telling us versus looking at my portfolio out. So customers did come back that they want a spicy pizza. It does well. We will add more into the range and hopefully create a property around this. And it so happened that when we looked at the price gaps what consumers were willing to pay, it was obviously higher than Pizza Mania. And when we benchmarked against competition, we continued to be the most competitive on this for this kind of a range. So that governs us. Sorry, I missed the second question you had asked. Inflation.
With respect to margins.
Yeah, so margin again, we've identified close to 75 projects internally through Project Vijay that we are tracking every Monday morning along with the leadership team. That's what I think will gives me comfort that we have enough ideas. Now we need to execute and continue to expand our margin. Inflationary environment, I felt it was cooling off, but the vegetable prices have come back and surprised everyone. So I think we're again living in very uncertain environment, be it due to natural factors or factors which are external, like war. There is a embargo on wheat from Ukraine. So I don't know how that will govern the commodity prices, something which I can't control, but internal efficiencies is what we are more focused on.
Understood. Thank you very much.
Thank you.
Thank you. The next question is from the line of Ashish Kanodia from Citi. Please go ahead.
Thank you for the opportunity, sir. So, firstly, on demand, and I understand that sequentially, ADS has improved, but I think part of it is also attributable to just the seasonality as well as some bit of impact of IPL. So, not necessarily looking at any numbers, but when you look at the demand environment, maybe sometime in June and then last 25 days of July, from a consumer sentiment perspective, do you see things improving versus what it was in the last 3-4 months, 5 months, and just excluding the seasonality, right? More from a like-to-like basis, do you see that the overall consumer sentiments are improving? And I think that would be the first question, sir.
I think it continues to be uncertain, the demand environment. But I'll again bring you back to the strategy that is playing out for us, which is focus on faster deliveries, focus on our own app traffic, improving the experience, improving the conversion, offer pizzas right from 49 rupees, which attracts a lot of new consumers, and take them along through in our Cheesy Rewards journey to come back and spend more of their wallet on our app or into the store. So those pieces actually give me the comfort that that they should only improve.
Sure, sir. That's helpful. And the second question is, on in the lines of your answer. So first on, the monthly active user and maybe the Domino's Cheesy Rewards, right? Is it fair to say that, as your Cheesy Reward, kind of contribution goes up, maybe the same, the monthly active user may not see a very high growth because, it's basically about conversion higher, so maybe because of your Cheesy Reward, your conversion rates are high and so the monthly active users data may not be a very good reflection of overall, demand environment. And the second thing was in terms of, some of the strategies you have taken. So, reimagining of stores in terms of improving the dine-in. So, it would be great to hear your thoughts in terms of, what percentage of stores you are looking to reimagine, say, maybe in this year. And secondly, have you seen similar to, what you shared about Bangalore? So, of the few stores which you have reimagined already, have you seen any demand improvement on those stores?
Yeah, so I think again, I will not read too much into the monthly active user base. Like I said, we just focused on more efficient channels to improve the marketing ROI. I think we continue to see new customer growth rate. Like I said, our sales continue to be order led. Therefore, from that perspective, we do see new customers. I mean, India is a country of more than 1 billion. Even if I look at immediate target addressable market, there are like 150 million monthly active food customers who order on food, and only like less than 10 or about 10 million are coming onto our app. So from that perspective, there is huge headroom to acquire new customers. Of course, customers enrolled in Cheesy Reward, they know what to expect. They are loyal. That cohort of whether they order 9 times a year or 6 times a year, that is increasing. That obviously has much higher conversion rate, very natural for the cohort. But the headroom to acquire new customers remains, and I think for a long time will continue to be, our growth will also be new customer led. On dine-in, we are reimaging stores. I think the presentation does talk about there are 1,400 stores out of 1,850 which are anyway our new age design or pizza theater design. On the balance, we are taking judicious calls on which stores to reimage. For example, if you live in North, you can go to Botanical Gardens in store and right under the metro. You will see that, or Advent in Noida. So you will see those stores reimage. They do exceedingly well. The dine-in weekly orders actually improve by 15 to 20%. And we also do a thorough assessment when and where to do. So that base is not high. It's not that we are going to reimage 500 or 600 stores. That's more around the 100 mark. Less than 10% is what we will reimage or relocate.
Sure, sir. And just last bit and two parts to it. First is on, the milk prices, cheese prices. So, there were news flow that the milk procurement prices has started to decline. So, while you may not have seen any immediate impact, but, given you have a relationship with the vendors for such a long time and you have better data than we have. So, I mean, if this trend continues, do you expect the cheese prices, at the price at which you are sourcing to decline? That's first part. And secondly, on Popeyes, just purely from this year perspective, when you say 30-35 stores, from a strategy perspective, would you like to go deeper into the existing market, or we will see more city being added? And the question is basically coming from the fact that the supply chain is a challenge in that category, and you're just setting up. So we have seen you expanding to 5 cities. So going forward, when we look at the balance 9 months, will it be more stores in this existing 5 cities, or maybe add few more cities. That would be all from my side. Thank you.
Yeah, thanks. So I think the milk prices would have seen a very little or a marginal decline in an environment where typically it increases, but it continues to be higher than what it was last year. So it has not fallen. There is no deflation in milk prices or cheese prices. If it were to go down below that, I think that's a call we'll take during that time. We have not really planned for it. We also did not pass on all the cost inflation into our input cost inflation to consumers. We absorbed as reflected in our margins. But I doubt, to be honest, that there will be a deflation in milk and cheese prices. I don't see it at the moment, actually. On Popeyes, so I don't think supply chain is a challenge. We are commissioning our big food factory in Bangalore, like Mr. Bhartiya talked about. In absence of that, we anyway work with vendors. I think what is most important to me is open the store in the right location. And in South India, our real estate team is building that pipeline. And we have, in the last 4 months itself, we have expanded beyond Bangalore to Chennai, Madurai, Coimbatore, and Hyderabad. So we are looking at more cities in South India for sure, and we've drawn plans to also expand to North India. So supply chain is not the bottleneck. I just wanted to assure that.
Sure, sir. Thank you.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Broking. Please go ahead.
Yeah, hi Sameer and team. Thanks for the opportunity. Just two quick questions. As you said that the inflation is still remain elevated, and we are trying to get the lower end of the pyramid. I mean, dining experiences is one of the thing, and you focus more on the volume. Now, in that sense, the two questions is that what is the impact of this whole refurbishment which has happened in terms of pizza theater design, and will that be able to drive the volume? Because if I look at, you have introduced cheesy reward, so that cheesy reward is basically to improve the traffic and improve the dine-in and the experience. But then if the inflation is not going to subside, even though volume growth will be there, our margin will be still stretched.
So Sirish, I think we have demonstrated that because of the internal efficiency that we are driving, despite high inflation, we have been able to sequentially improve margins. And secondly, despite a lot of focus on order-led growth and therefore focus on low price point, we had earlier also talked about the 49 rupees price point, which I think is unique in the country because no other competition offers a price point which allows customers to enter. Despite that, we have been able to again improve our margins. Because we have the full spectrum of the price piano that we play, and I think we have been able to also drive mix to our advantage. And so despite absorbing the impact of inflation, despite absorbing the fact that there were minimum wages increase throughout the country in the last quarter, we have been able to improve our gross margin by 70 basis points and EBITDA margin by 100 basis points. Combination of driving internal efficiency, and Sameer has talked about it across the organization, along with driving mix in a very, very focused manner, and also targeted discounts, which improves our overall ROI on discounts. I think a host of these measures gives us the confidence that despite an elevated inflation, which seems to have stabilized, at least sequentially we are not seeing too much of inflation, and our continued focus on driving mix and internal efficiency will help us, at least keep the margin stable or improve from it.
The second question is on the volume again. Though we have introduced 49 to 169, and now we have got...
Sir, this is the operator. I'm so sorry to interrupt. Requesting you to please speak a bit louder. Your audio is not audible.
Yeah.
Thank you.
This is again the question on volume. We have introduced 49, and we heard, Sameer, you said that 49 to 149 is the sweet place where we are driving the volume, but we have also now introduced and premiumizing at 169 rupees. So is it sufficiently enough gives the room for the premiumization, and therefore you are again confident that the margin may not deteriorate from here?
So, okay. So then there are two different questions. Does the range give enough width? And I think in this investor presentation, we've shared that our range starts at 49 rupees and goes all the way to 1,149. So in fact, we are the only I would say QSR company that offered that kind of a range. On the right hand spectrum, you have the gourmet pizza with almost 5 kinds of different cheeses, and on the left hand side of the spectrum, you have a base 49 rupee product. So therefore we have the menu width to cater to various segments and various tiers of the society and cities. Now your question around what will happen to margins, we have demonstrated that there is no gross margin impact, and through internal efficiencies, we've in fact been able to improve our EBITDA margin. So again, like Ashish mentioned, and I also alluded, margin should remain stable or improve from here, and I don't see any concern unless until there is some unprecedented inflationary environment that we put ourselves into it.
Sure. Okay. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi team, two questions from my side. So firstly, on the cost efficiency plans that you have, just wanted a flavor of how much of that have you already implemented, and the results of which are visible in this quarterly results, and how much you are yet to implement, and that will give further sort of margin expansion in the coming quarters.
Yeah, I think it's
just a percentage, rough sort of indication that like 60%, 70% we have implemented, or whatever that number is, will be okay with me.
Percy, great question. I think this is a constant, I would say, a never-ending battle that I tell my team that we always have to be more efficient than yesterday, and there will always be new headwinds that we will see, for example, tomato prices this quarter. So I would refrain from telling you that we are like 50% done or 70% done. I will only tell you we have a lot more opportunity, and I'm not going to leave it. And my team meets every Monday morning first thing to expand the hopper and also implement what is on our plate.
Right. Samir, what I meant was, I understand this is always an ongoing thing and it can continue for many years and it can actually be a perpetual thing. What I meant to ask is that you said that you have identified some 80 ideas, right? So I'm restricting myself to that there might be some ideas you have identified but you have yet not implemented, and that could give more margin expansion in the future. I was just trying to get a sense on how much is already in the bag and how much will come.
I think there are, let me assure you, Percy, I think, sorry, I understand this question better now. There are enough and more ideas that we have, and the team is like steadfast focused on implementation. I'll refrain from saying whether we implemented 40% or 60% or 20%. That is, that would tantamount to giving a guidance for future. So, but let me assure you, teams are focused on all cost line items. We know where to find the opportunity, and we have a named program and a leader for every initiative.
Sure. If I were to ask a slightly different question, that let's say, what is a target for a stable state margin 2 years down the line or 3 years down the line? Like you are currently at 21%. In the COVID peak, you had gone to 26 plus. So obviously that probably was not a very sustainable margin. Neither is the current margin sustainable, and probably it will be somewhere in between. But it's a very wide range. So just your thoughts on what you think this format or this brand deserves as a sustainable, stable state kind of a margin.
Percy, I think again, without giving any guidance, our internal endeavor in the long run will be to at least stabilize between 23-24%. I think that's a good state to be in. When do we get there? I think it remains a question mark. But I think our endeavors and all our efforts are towards getting to that level. I think 26 was of course unsustainable. 23 to 24 would be a good level to get.
Right. Thank you. My second and last question is on the dine-in. So you said that 1,400 restaurants are already under the sort of new format out of 1,800. So that's a very large percentage. So, and despite that, dine-in is not really picking up. So what more needs to be done from your side for the dine-in to pick up?
Yeah, no, I think so. Firstly, we need to recognize that post-COVID, there is a permanent demand shift towards delivery. Therefore, you will see all QSR companies investing in their delivery channel, and thankfully that channel works for us. I would say there are a few bottom stores that we need to correct, right? And that I've seen a material decline. That number, like I said, is about less than 10%. Will get to about 100 odd stores this year, and that is the only way out of it. And of course, making sure we execute flawlessly in terms of giving a hot pizza on the plate in time. So making sure the functional excellence continues to be high. Those are the pieces, and which will bring back the growth in dine-in.
Got it. That's all from my side. Thanks and all the best, Samir.
Thank you.
Thanks, Percy.
Thank you. The next question is from the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity. First question on the employee costs. There has been an increase of more than 20% year on year, significantly higher compared to increase in sales. Is it because of aggressive expansion and the minimum wage which you mentioned, or is there any one-off in this?
So, Kunal, three primary reasons. One, of course, is the minimum wage, and it's been higher this year than what we have seen in the past. Second, of course, we've expanded our store network significantly in the last 1 year or so. So that cost, again, is reflecting there. And the third is also a bit of a mixed impact because the variable manpower cost reflects in other manufacturing costs. So there has been a slightly adverse mix this quarter as compared to previous quarter or last year.
How do you see this?
But overall, of course, it reduces our cost because you see we have not seen a proportionate increase in other manufacturing and other costs. So some of it is a mix as well.
Understood. Okay. That's one. Second one was if you can share your thoughts on DP Eurasia stake now. The stock has come off very significantly compared to the open offer price which you had in 2021. Would you look to acquire more, or is there a risk of write-off due to erosion in value?
So there is no erosion in value, and we believe that the underlying value of the business is significantly higher than what is reflected currently. So there is no erosion in value, and we do not see any impairment risk for this year, for sure. As far as further acquisition is concerned, I think unable to give any guidance on that because our board mandate is only to go up to 49.95 and not beyond. So I think we are pretty close to that number already now.
Okay, thanks. And just one last question on financial impact of the new commissary which is coming up next month. What kind of operating cost, depreciation or cost savings or any revenue benefits we should be factoring in from the Bangalore commissary?
Sure. So once the factory fully commissions, there will be two impacts. One, at an operating cost level, we will see some savings because we'll be insourcing or bringing some of our activities that we were doing through third party in-house, and because of the scale and the way the plant has been built, we will see some operating goodness flowing into our payment. But of course, we'll have a slightly higher depreciation, but the impact will be not significant given the fact that we will, of course, be depreciating this cost over close to 15 years. So I think net impact should be minimal. We'll have some operating efficiency gain and some additional depreciation.
That's very clear. Thank you. That's it from my side.
Thank you. The next question is from the line of Varun Singh from ICICI Securities. Please go ahead. Mr. Varun Singh, your line is unmuted. Yes.
Am I audible?
Yes, sir, you are.
Yeah, right. Okay. Thank you for the opportunity, sir. My question is I understand that all the vectors or the strategic intervention that we have executed to solve for SSSG. If you have to choose, or if we ask you that what would be that one key vector that you will give the topmost priority to solve for the subdued same-store sales growth or to reach to 7 to 10% kind of SSSG, what would be that vector as per you, sir?
Yeah, I think it's and I may sound a bit professorial over here. Firstly, there is no silver bullet over here. We have to execute on every pizza, every store all the time, right? That's the hard part of managing such distributed operations, Varun. So there is no silver bullet. But if you force me to pick one, I would say it is the culture and the people as our foundation, right? That is when it rains, you will see it actually. Some of the parts of North Indian were flooded, and I could see our delivery riders, almost water coming to knee level, actually driving and delivering pizzas. I went to stores at near midnight, 11:30, 12 in Gurgaon, and I was asking why your pants are folded up, and they showed me how deep the water was. So I think that's what makes the difference ultimately. It is the passion to serve the customers. It is the domino spirit in terms of hustle when there are more orders and take the ownership to get to the customer. That is where we differentiate, and that is the true secret sauce, and not necessarily the pizza, the menu offering or the technology. Ultimately, pizza has to be made with love, which is 5-star, taken to the customer in 20 minutes and served with a smile. That is the hard part.
Got it. And sir, like the 1400 odd stores, where we already have, done store reimagination, how is the dine-in performance in these stores?
Yeah. So 1400 store we opened with the ACE design or pizza theater design. So therefore they don't need any correction. They obviously do better than the older format stores, and that we are very rapidly correcting that. So these stores which are what we call as ACE design or pizza theater design, they have higher dine-in ratios versus the other. And we do track, by the way, before and after, and we do see healthy dine-in weekly orders, and also the overall weekly orders, because dine-in is a big channel for new customer recruitment, so it has a big rub-off effect on delivery also.
Some objective measurement when you say healthy dine-in? Is that like instead of 60-40, 50-50 or anything of that sort?
Yeah, what it see internally, what we're seeing is it does anywhere from 12 to 20% dine-in sales improve before and after. So again, what we do in a daily is to serve customers across channel versus look at the mix. So whenever we reimage a store, we see it anywhere from 12 to 20% improvement in the dine-in sales.
Got it. And sir, my last question is on the loyalty program. So currently 48% 48% is the revenue share. So by when you expect this to reach kind of 100%?
Yeah, I think hopefully never, right? That would mean that we are not acquiring new customers. So like I said, there are like 120 million monthly active customers who are buying food on various channels. We get only 10-11 million of that. So for a long time to come, we should acquire new customers. In more, when the program matures, what we've seen in other geographies, it stabilizes around 60%.
Understood, sir. That's it from my side, sir. Thank you very much.
Thank you, Varun.
Thank you. We take the last question from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, sir. Hi. Thanks for the opportunity. Sir, we have earlier delivered about 78 to 79% gross margins in certain quarters, and we are currently at about 76%. I wanted to check, is this difference largely because of food inflation, or there are other elements of, say, higher competitive intensity or adverse channel mix also in this?
So Devanshu, I think those margins were largely on the back of a significantly deflated commodity environment. And that we have not seen for now almost close to 2 years. We have seen unprecedented inflation in the last 4 to 6 quarters. So I think really not comparable. And I'm not sure when we will see those kind of commodity cycles again. And therefore, as Samir alluded to earlier, a lot of our focus has been on driving our mix and at the same time driving internal efficiencies to continue to improve gross margins and overall EBITDA margins.
Okay. And sir, as you said, 23-24% is the endeavor on EBITDA margin front. So what would be a similar number for gross margin?
So it will be a combination of what gross margin and EBITDA margin. I think it will be difficult to give a gross margin number because a large part of the gross margin delivery is dependent on how the commodity prices pan out. And that is why we are focusing on every line of cost to drive efficiency and drive overall productivity in the P&L. So I think it will be a combination of both, but it will come more from non-gross margin is my prognosis, because gross margins are more difficult to drive given the commodity, and the inflation cycles.
Right. Lastly, sir, Hongs has seen 2 additions in this quarter. So just want you to check, are we at a level where unit metrics and the product composition, etc. are solved, and we can see sort of faster acceleration for this format?
Yeah, I think we're again very happy with the progress the team from Hongs is doing. They are truly building an Indian-style Chinese QSR format, which again serves across channels. They have their own delivery and also their own app. So again, what they have been able to demonstrate is very high customer repeats and the love for the food. I think that having solved, I would still say that they have a bit of a job to do on demonstrating consistently store economics. By the way, the store that we opened in Lakshmi Nagar has become one of the best stores very quickly in a span of about 2 months. So again, I'm giving you these anecdotes to give you my confidence on how the team is executing. But there is before we go all out and open the floodgates of expansion, they have a bit of a work to do. Largely on the economics, unit economics side of it. But many problems or many big rocks have been actually solved for.
Sure, sir. And all these formats will be supplied through common commissaries.
Yeah, I think this is what we bring as a horizontal capabilities. There are actually 4 capabilities. One is our manufacturing. Second is logistics, because the same truck which carries dough balls for Domino's can actually service the store. Number 3 is our technology capabilities. The same engineering team which builds the Domino's app actually builds the other apps. And number 4 is the last mile capability in terms of workforce management, delivery riders, and route mapping, route planning, etc. So all those 4 capabilities are horizontal capabilities. They can be bolted onto any new brand that is an international brand or we are developing.
Got it, sir. That's helpful. Thank you.
Thank you very much. Ladies and gentlemen, that was the last question for today. On behalf of Jubilant Foodworks Limited, that concludes this conference. Thank you all for joining. You may now disconnect your lines.